and the panelists who have joined us for the webinar on regulatory changes in Schedule 3 and CARO 2020 reporting. Thank you so much, our distinguished speaker, Mr. Vikram, as well as Mr. Balakrishnan, for consenting to participate in today's session. And at the FTCCI, we take this conscious effort to ensure that all the webinars or events that we organize are more of a knowledge sharing platform for our members. And we can see that already 63 delegates have registered. So we know exactly what's the demand and how our members are going to benefit from this. Before we begin the session, we would like to show a short promotional video of the FTCCI. This is specifically more for the non-members who have joined us. And in fact, I would also appeal to the non-members who have joined us to join FTCCI so that regularly they can be updated on the new trends, the new policy, the new amendments through our knowledge sharing platform.
The largest business organization of Telangana state. With a legacy of excellence, the voice of the industry, representing the interests of 25,000 businesses of all sizes, sectors and regions. Empowering trade through advocacy, solution and standard setting. Opening new avenues for unprecedented growth. Laying the foundation for an industrial transformation in the state of Telangana. Now, poised for the next century and beyond. The Federation of Telangana Chambers of Commerce and Industry, FTCCI. Together, let's rewrite the vision for a progressive future.
Thank you so much. I now invite our President, Mr. Bhaskar Reddy, to deliver the welcome address.
Thank you, Kathy. It gives me great pleasure in extending my warm welcome to our chief guest, Chartered Accountant Sri M.R. Vikram, partner Anandam and Company, Hyderabad, and today's speaker, Chartered Accountant Ganesh Balakrishnan, partner Deloitte, Haskins and Sells LLP, Hyderabad. I also extend my warm welcome to our past presidents, Raju Garu, Tirumalai Garu, and MC members, and Dr. Tasneem, co-chairperson, Corporate Laws Committee, FTCCI, and distinguished participants, ladies and gentlemen. The Ministry of Corporate Affairs, Government of India issued notification, I think during March 2021, to amend Schedule 3 to the Companies Act 2013 to enhance the disclosures required to be made by the company in its financial statements, board reports, and audit reports. These disclosures requirements, as well as principles to be followed for the preparation of financial statements, have been substantially amended and will come into effect from financial year 2021-22 itself. The majority of the amendments are in line with the new CARO reporting, and all these changes are aimed to strengthen the corporate governance practices of the company. This will help the persons reading the statements get a better understanding of the functioning of the company. I think today's speakers, both Mr. M.R. Vikram and Ganesh Balakrishnan, carries the wealth of knowledge and experience, will definitely benefit all our participants. And I'm very confident that today's deliberations will enrich our knowledge. And once again, I welcome all the participants. Thank you very much for joining us today. Thank you.
Thank you, sir. So very good afternoon to all the panelists and all the viewers. So we all know that Companies Act, there are various amendments going on. All the companies are at the verge of closure of their balance sheet. And this topic is so apt at this time. And I would really thank Naresh sir for taking this topic and inviting two senior most chartered accountants on the dais. So everyone is aware that Schedule 3 of the Companies Act was modified by notification March 24, 21 to enhance the various additional disclosure requirements while preparing the financial statements of a company. Moreover, these amendments are applicable to audit reports issued in respect of accounting years commencing on or after April 1st, 2021. The main aim of the amendments in Schedule 3 of the Act is to improve the transparency in the financial statements of the company. By these amendments, MCA is increasing stringency in compliance and adding numerous additional disclosures in financial statements, director's report, and as well audit report. In recent years, there have been substantial changes in reporting requirements by the auditors, but no such corresponding amendments were made in Schedule 3 in the preparation of financial statements. Thus, to align the company's financial statements in accordance with the auditor's reporting requirements, Schedule 3 has been amended. I am sure our two experts on the dais today will enlighten with these amendments. I would like to introduce CA Ravindra Vikram, who is a senior partner for Anandam and Co. I will take you through his brief profile. Sir is a graduate in science and law. He is a senior partner of one of the leading and renowned CA firm in India, Anandam and Co. His experience itself is an added qualification for him. He has 4 decades of experience in audit, assurance, banking, and is an expert on finance and regulatory issues. He also served as a director in Indian Bank, Indian Overseas Bank, and Bank of Rajasthan. Currently, he is serving as director in 13 companies, which includes 2 listed companies. Mr. Vikram has conducted various research studies for the Reserve Bank of India, IRDA, and other leading financial institutions in the country. I had taken you through his professional journey. Now, stay tuned. I'm taking you through his social welfare journey. So he is a trustee, a secretary of MV Foundation, which is also a 40-year-old organization which helps in eradication of child labor in India. He is also a founder trustee of Manthan, an important intellectual group for discussion in Hyderabad. So please put your hands together to welcome our courtly committed, charming chief guest, CA Ravindra Vikram. Sir, we are eagerly waiting to hear from you. The dais for you, sir.
Thank you. Thank you, Tasneem, for your warm introduction. I must say that you have crossed your limits because Naresh asked me for my biodata, and I remember having given 7 words and somehow it became 70. I don't know who did that. I am regularly on Manthan, and I strongly believe that people should judge others by the way they speak, not by their past biodata. That's why I like short biodata. But anyway, thank you very much for your warm words. And I must thank Bhaskar. It's nice to see him after so many years. He's much thinner than what I saw him last. And more important, there's a nice platform where I see Rajagaru. He's been a doyen in regulations for all of us, and my old friend and client Jaydev, and all of you. Thank you for giving this opportunity. And also thank you for making it possible for me to precede someone who is an expert in this, Ganesh Balakrishnan. I think that in the city of, maybe in South India, but definitely in the city of Hyderabad, no one can be better informed on this issue as what we're about to discuss. I wouldn't discuss the details of Schedule 3 or because I think I should leave it to the speaker. But I want to raise only a few issues here as to, there is an argument that in this drive for transparency in financial statements, are we over-transparent? Is there over-regulation? And if there is over-regulation, are we chasing people out of the corporate structure? Is it easier for me to form an LLP? Why don't I have a partnership where I don't have to give these kind of details? I mean, the kind of disclosures we have to make, is it burdensome? I think that these questions can be answered first from the question, for the first question which came to my mind when I was preparing in the morning, as to who are corporates responsible to. I think that that question needs to be answered. Are we responsible to, as a running a corporate, are we responsible to our shareholders? Are we responsible to our bankers? Where a company does not borrow, are we responsible to our creditors? Are we responsible to the government? Who are we responsible to? And are these financial statements any longer, is it correct to call them financial statements? Shouldn't it be called statements of accountability and responsibility? And I think the time has come when we should change the title from financial statements to statements of accounting, accountability and responsibility. And I think that when a company chooses to have a corporate structure, it is not just the structure they're choosing only for their shareholders. The report aptly for the auditors are addressed to the shareholders. But the board of directors, when they prepare a report, while calling it the report to the shareholders, they're simultaneously saying it is a report to the public at large. They're reporting to the government, they're reporting to the bankers, they're reporting both to their debtors and creditors, they're reporting to their employees, they're reporting to the people who have supported them, who are with them at various levels. And all these people need to know what is happening in the corporate structure. I must say that one of the first things we learned when we learned company law is that we were told that a company is a company because it has perpetual succession and a common seal. Of course, common seal is now very, very common. I don't think that's a challenge anymore. When we were young, getting a common seal was a challenge because it was, if I remember right, it used to come from somewhere in Kanpur. But now it is a well-known technology. But I would like to point out on this thing of perpetual succession. We are saying that till it is liquidated, till it is closed, a company is in one sense a living corporation. And a living entity needs a lot of disclosures. In a living entity, when you are dealing with a living entity, you need to know who we are dealing with. What kind of a person is he? What kind of contracts they are getting into? What kind of commitments do they have? What kind of structures do they have internally? This recognition of a perpetual succession should form the basis of our deciding whether we are over or under disclosing. It is when we say that we are choosing a corporate structure simultaneously, we are also saying that it is an act of confidence. It is an act of transparency in the sense that we have nothing to hide. There is one more aspect to in a corporate structure, and which has been substantially diluted in the context of banking, but not really so. Another aspect is limited liability. When we say that a company has a limited liability, we are strongly recognizing that a shareholder is different from a company. We are saying that the people who have invested in the company are different from the company. And if the people who have invested also want to deal with the company, like each one of us who are not shareholders, they also have to enter into a contractual arrangement. They have to disclose the nature of arrangements. And limited liability would mean that their liability is limited to the amount they have invested. Now, look at it this way. Banks, when they lend money, also take personal guarantees. When they take personal guarantees, in one way, many people say it vitiates the limited liability of the shareholder because the shareholder is taking on a personal contract. But then people miss that when you take on a personal guarantee, you are entering into a separate contract. The company as such, the company has its shareholders as a limited liability. So when you have a limited liability there, And when you say that the company is responsible only for, the shareholders are only responsible for so much, then I need to know what is happening inside the company. I need to know, if you see one of the amendments which Ganesh, I'm sure, will point out to, I need to know whether you're paying your creditors in time, whether you are recovering your debts in time, whether you are disclosing your obligations to banks correctly and in time, whether your books and what the banks say and what you tell the banks is the same, is consistent. Now, there will be an argument. There is an argument which says that these questions are supposed to be answered separately. Why should we disclose it in the annual report? The banker can come and ask me whether I'm doing this. The creditor can come and ask me whether I'm doing this. Now we shift our argument that the company has to do its business. And part of the business is an annual disclosure of its relationship. That annual disclosure is as important as doing the business. It is very, very important for the company to do its business in what we can call as a regulated, under the rules of the corporate governance. And these regulated corporate governance rules are as important even if there is only one shareholder, because a company is different from its shareholder. There are some dilutions in this where there is a one-man company and the Companies Act 2013 has slightly diluted it. But the core of the problem, the core of the solution as we see it, is because the company is different. Government as a regulator is taking on the stance that please tell people about all your relationships. Please tell them whether your fixed assets are in place. Tell them that whether you have title deeds. No, you might say that why should I have a large company, I'm Tata Steel. I have 1 million assets in my on my books. And there will be some assets where I don't have title deeds. What is the limit for disclosure? Do I give a complete list? Today, as I was preparing, my partner asked me, sir, the way they're disclosing, I think it's easier to attach a trial balance instead of giving an annual balance sheet. And let us disclose in full. Though it was said sarcastically, I did tell her, no, you are missing the point. The point is, in her drive for transparency and accountability, they also want you to know that we have to be careful on what we are disclosing and how we are doing business and how much we are disclosing. They can only give you guidelines. We're going to always disclose these things. And you would notice, world over, there is enough research to say that large companies which have adequate disclosures are valued better in the stock market. Infosys gets an extra PE, not now. Now many people are following that path, an extra multiple because their disclosure practices were superior to in the peers in the industry. There is a strong correlation between disclosures and transparency. There is a strong correlation between disclosures and valuation. So I would only say this in the end, that what we are seeing should be seen as a building block in building a good corporate atmosphere. It should not be seen as a burden. Of course, in India, I must say, regulation is burdensome. Someone the other day, one industrialist commented, there are 863, if I remember that number right, 863 compliances and approvals a company has to do every year. 863 forms that have to be filled up at various times. And it's not a small number. But that burden should not be confused with the demand of the society on the corporate. So which society wants to know how is this corporate dealing? And I think that these additional disclosures are in the right direction. Though it is initially it will be seen as an irritant, but I think over a period of time, people will understand this is the best way to induce corporate discipline and to protect the corporate structure in this country. I thank you for giving me this opportunity, and I'm sure that what Ganesh is about to say will be of great interest to all of us. Thank you.
Thank you, sir. Thank you very much, Vikram, sir. You have, I am sure the next speaker will enlighten more about the Schedule 3 amendments and all. So let me introduce our next speaker of the day, Mr. Ganesh Balakrishnan. He is a senior managing partner of Deloitte in the audit and assurance practice with 3 decades of experience. He graduated from Osmania University and is a fellow member of the Institute of Chartered Accountants and Cost Accountants as well. He is also a certified public accountant from American Institute of CPAs. So his list of acknowledgements, accomplishments are a bit lengthy. Please bear with me. So Mr. Ganesh heads the learning and development for the South Asia cluster for Deloitte audit function. He is part of the IFRS faculty with the Institute of Chartered Accountants. He has served as a member of research committee and also as member of auditing and assurance for ICAI. He has been involved in the preparation of implementation guide on materiality, sampling and going concern released by Accounting, Auditing and Assurance Standards Board. He is associated with Quality Review Board and Peer Review Board for technical reviews for accounting firms. He is on the regular faculty of ICAI. He has undertaken IFRS training for Osmania University faculties. He has presented his papers in various forums in India and international universities. Sir, we are all delighted, overwhelmed to have you here with us today. With your wide experience, I am sure we will be empowered today. Sir, we all can't wait to hear from you. Over to you, sir.
Very good evening to everyone, and thank you very much. I mean, it's not like Ram Gopal Verma's tweets that are going on, so where everybody is excited to hear. I think CARO is also on the same front. And thank you, Vikram. I think you actually emphasized and you actually brought in some of the points, and I think it's very interesting because I want to touch upon this thing as to why. Why do we need regulations? Are we talking about being transparent, bringing transparency in the name of regulation or over regulations? You also touched upon the statement of accountability and responsibility. I will talk about as we go through it, and I think it's a very important aspect of it. You know, we are in the schools taught about moral science, right? Honesty is the best policy. I do not know whether as we went through our career, whether the honesty took a back seat. And I think I'll tell you why that is very, very important. You know, why this whole changes have been brought in. The fundamental issue which has come up is that trust element has gone down to the lowest level. Whether you call it corporate, whether you call it auditors, whether you call it anyone, the trust element in the eyes of the stakeholders, and I'll touch upon why that is very important. If you look at the, you know, because you're from the banking industry and you have so much of knowledge in banking industry, the NPA stood approximately 8.3 lakh crores, which is approximately 25% of our total budget for 21-22. So when we are saying that where did this money go? And this is bank's money, where did it go? So we are sitting on a pile of bad debts. And why do we need this? And again, this brings back that, you know, receivables, that brings back security. I'll touch upon each one of that. But fundamentally, we need to understand, have we chasing bad money? Are we chasing good money? In fact, it's the other way around. The bad monies have actually grown up so much in this country that somewhere we need to start rethinking as to what we are doing is correct or not. Companies Act 2013, when it was introduced, at such rules and regulations, which actually brought in the discipline of governance. Unfortunately, governance has been slightly put as governance by convenience. Why do I say governance by convenience? Is because whatever things that were relevant for the corporates have gone back into back burner. The point is for related party transactions. If you take the case of the fraud alone in India on the banks, it is 13.84 billion rupees in India. And just imagine, fraud on the banks is alone 13.8, and this is for a period of about 3 years time frame I'm talking about. What do you mean by fraud on the banks? The fraud on the banks came up on securities that was given. The fraud on the banks came on the inventory as the nature of working capital that was submitted. The fraud on the banks came in terms of all loans which were shown as recoverable. The fraud on the banks came up on all those receivables which were shown as good and recoverable. And that is the reason why you had to bring in this aspect of changes. Now, the real question came up, and I think I'll bring you the background as to why Schedule 3 changed. We had Schedule 6 and everything undergone to Schedule 3. CARO was introduced, and they said auditors are responsible. I can tell you across, if you are auditing a company, probably you may know 10 or 15% of the entire thing. All the transactions is only the person who does will know about it. Whether it's a related party transaction, which is a transaction with those promoters group, transaction with anybody else. The information that happens, which comes up in the nature of whether a transaction with a promoter, known person, key managerial person, will only come if the auditors stumble upon that information, like addresses being the same, the relationship being the same. In fact, there are a lot of advisors who come back and say, hey, listen, related party transaction under Companies Act definition is this, so therefore you look at outside of this. So if brother's wife does not come under, make that person as a party to it and enter into a transaction. Then I'll touch upon why these are very, very essential, which is actually evolving all of it. When companies' balance sheet was sent across to various stakeholders, whether it could be CII, whether it is the Federation Chamber of Commerce, or whether it is ASSOCHAM or ROC or banks, everywhere it was sent across. The first thing which comes back is resistance. When technology is changing, and I'm again going to come back to you, you made a very valid point. No longer balance sheet will be seen in another down the 5 years, you may not even have a balance sheet. Because of the technology that is showing that moment the banker has to finance you, all your systems will be connected to the server of the banker, and the banker will review it and release it. The income tax department will look at in terms of this and give it. So you may not need an audit, you may not need a financial statement. That will be the future of this Schedule 3, whatever it is. Today, it's because statutory required in India. Outside of India, it is not mandatory required to have a financial statement and audited financial statements. It's only in respect of listed companies, which their requirement is under the respective regulators. So the background behind this is a lot of inputs have come up from stakeholders like ROC, like banks, like income tax departments by way of these things. Now, have we outlived the hospitality, right, of trust? Ante alludu garu laga, have you lost it? The answer is yes. Because all this while, we had a system, we had a governance, we had an audit committee, we had a board of directors, we had all of these directors report. But if you really see the connection between a director's report, an audit committee meetings, and a financial statement, and an auditor's report, it does not convey anything. It is like in our movies, which they show, the trailer looks exciting. The inside information, when you watch the movie, it is not much. Now, with this introduction of Schedule 3, any person will be able to evaluate each aspect of it, and I'll touch upon those aspects. The second thing is, which so much of focus which has gone into technology. Don't be surprised, today we are having a challenge with the income tax portal. That's all because there is humongous data which is getting captured from GST, getting captured from SEBI, getting captured from banks, that's the reason why there's a biggest challenge. The day it gets automated and auto-populated, when I say auto-populated, all of your information that you transact with the bank, except for cash, as long as you do dealings with cash, it may not get reflected. But any expenditure that you incurred up to a particular site, whether it's your capital expenditure, whether it's your foreign travel, whether it's your electricity, name anything which is based on a threshold, will be captured in your auto-populated income tax form. And that is where the journey is come through. across sweeping changes that are coming through. And this is for what? This is good for the future. Today, we have to come back to the same glory when 20 years ago or 25 years ago, when auditor was respected, financial statements was respected. Today, everything is a financial model, a financial modeling for which you call a PE investor, you may call a listed, or you may, because today I'm not getting money anywhere, your stock mentors are is going up at a very high level. Every stock prices, every IPOs are getting listed X number of times, and therefore it is a speculation that is happening. Does this speak the strength, financial strength of a balance sheet? The answer is no. So we have to come back now. Are we chewing more than we can bite? And I think that is what will come through, not now. This is the IPO season. Wait for another 2 years. You'll have one more of the downfalls that can come through it, because you cannot overprice if your business model does not reflect the value in what you receive. And the value in what you receive is nothing but your cash on hand. If any business have to succeed, in fact, what Vikram, you talked about, Mr. Sajdev talked about, put it everything the money. What you earn, if you put in the money, it grows. It's like plant giving a seed and a plant grows into a tree, and the tree gives you fruits. Similarly, if cash is not there, all transactions go through what is called as book accounting, then the downfall is imminent. And I'll touch upon some of those aspects as we go along. So today I'm going to talk to you about, and please put in your questions in your Q&A. Please put in your questions in the chat box. I'll try to answer to the extent that I will be able to do it. Now, fundamentally, Schedule 3, why was it changed? Because they said auditor's report got undergone change, and that's the reason it is called as 2020. In the last year, when, in 2019, when the MCA introduced, every time they introduced in the month of March, they said, effective 1st of April 2020, CARO is applicable. Now, if you make auditors responsible, but not make the preparers responsible, then it is like, one way the company would say, this is not required under the Act, so why do I need to give information? The other way, the auditor says, no, this is required under my auditor's report. The person says, it's your auditor's report, you write anything. Then when the representation was made to the MC and to the government, then they said, hey, listen, who prepares the financial statements? It's the management. Who is responsible first? It's the management. When does auditor comes? Auditor comes subsequently. And therefore, they made the Schedule 3. So therefore, today, Schedule 3 is effective 1st of April 2021. Again, there are classifications between those under Division 1, Division 2, and Division 3. Division 1, nothing but classification based upon the accounting standard rules of 2006. In other words, if you're small, medium enterprises, or if you're enterprises which does not covered under the Indian accounting standard, the new Indian accounting standards, that falls under Division 1. There are very few exceptions that have been removed from there, especially relating to fair valuation. The second one is the Division 2. The Division 2 is nothing but the Indian accounting standard rules, which is applicable across. And Division 3 is nothing but the NBFC. So they have categorized between this. Now, what is very important that you should also understand that, the classification of micro, small, and medium enterprises have undergone change effective 1st of July 2020, wherein right from the investments to the turnover, it has been inserted. Suppose you say micro, investment of 1 crore to a turnover of 5 crores. If you say small, 10 crores to 50 crores. If you say medium, 50 crores to 250 crores. Just think through this. Now, if I were to take one simple example, whether there is a borrowing of any working capital more than 5, or any working capital loan or loans more than 5 crores. Now, even if I'm a small, medium enterprise, probably because of the threshold limit of 10 crores, if I have a debt and an equity of 60-40, probably I may be covered under that. So you need to be very, very careful relating to that. Earlier definition was much, much lower, but now in the current definition, it is enhanced. The other aspect which you need to look and understand is, how does this impact and why does this impact? Now, someone can say, hey, listen, similar to what you have in a tax audit, the presumptive tax positions that you can take, you can say, for all these private limited companies, this is not applicable. Instead of going back and saying, for accounting standards, it's not applicable. But if you were to see the maximum, while you might say there are major parties for which there has been, if you see the NCLT's orders, where there are larger haircuts that have been taken for the larger companies to hive off the NPAs. But if you were to look at it, even the smaller companies add to the pool of where there are haircuts. Now, today banks, the whole problem came up is because of frauds that have been getting emerged over a period of time. Frauds are there. Has it been there just because of an act, the frauds will reduce? The answer is no. But the awareness that has been brought in by bringing this information, who is accountable? Section 134, when you talk about Section 134 under the Companies Act, the board of directors are responsible. In fact, this is where I would want to bring back, because the board of directors makes a responsibility statement saying that they are responsible for safeguarding of assets of the company. Now, if one were to really understand they're responsible, then they should have more details. Now, that is where the whole thing is emerging out. Even SEBI is coming out more on the independent directors. Now, is it going to stop now here? The answer is no, it's going to go up. So I'll touch upon some of this. There are some sweeping changes that have been brought in the CARO as well as in Schedule 3. I'll touch upon those. There are two aspects you need to look at it. One, which has got critical matters which needs to be focused by the companies. Vikram raised a very important point on fixed assets, the security. Why should I give title deeds? And let me tell you, in today's world of where fraud happens in many of the land dealings, if you were to dissect the balance sheet of some of the companies, not all companies, some of the balance sheets, when they go for a haircut or when they go for a negotiation with the banks for refunding, refinancing, there's a haircut which goes through it, and the banker says you bring this money in the nature of additional capital. And you really find that this additional capital is only brought in as share capital in advance in share capital, but not converted into share capital. The moment you convert that into share capital, if you're a loss-making company, the net worth is eroded. If you say advance for share capital, it is never converted, it comes in the nature of a loan. And this is where many of the companies play. Two, the funding went on the same assets. Some of the companies went on refunding on the same assets. So now what do? You have fixed assets. Now your assets are depreciated. You need a loan. So the assets are again sold as a scrap, repainted, brought in back, and therefore a new refinancing happens. Now, is this applicable because of few people, the whole crowd should be suffering? That's the story. Can you dissect those people and then go after the people? The answer is no. The only way you can benchmark all of these is bring a regulations which will not only impact the largest, but also impact the smaller part of it. And I'll talk about the charges when I come into that details. Applicabilities, this is already applicable. It's applicable, almost 6 months is getting over. We're already into September. I've talked about disclosure division-wise and brings upon the transparency in which Vikram Dutch mentioned about it. It aligns with the auditor's report. Now, whatever the auditors say and whatever the management says should be the same. One typical example that one way to look at any auditor's report comes on fixed assets. In every auditor's report, almost majority of the audit report, the auditor will be writing, the company is in the process of carrying out physical verification, or the company is in the process of updating fixed asset register. As and when the physical fixed asset is recorded, any discrepancy would be adjusted thereupon. Now tell me, right from the Companies Act 1956 to Companies Act 2013, you've been writing the same story. Are you saying that for all this year, the fixed asset register was not updated? Merely because now you say you give me the property, title name, details, who's held, and now there's a problem. The fundamental challenge that came up is that neither the auditor nor the company were transparent. And if you look at really honestly, the auditors used to continuously write saying the company is in the process. The company carries out a physical verification in a phased manner. But if you see the charge that is created, there are two charges which it talks about. One is a charge that is created on the company for which the borrowing is there. But typically, Vikram said, I'm extending the personal guarantee. Why do you want to extend the personal guarantee? Because you want an enhanced limit. Because you want an enhanced limit, you do not have additional sources. Therefore, you say, hey, listen, I will give my personal property on which, a personal guarantee on which I will get this amount. It could be true, it may not be true, because always the security should be large. So that is one of the reasons why promoters used to extend that. And there's always used to be a bone of contention, because promoters' properties, once you give, who validates that? And I'll touch upon who validates that and why that is important. And that's where the charge comes into an issue. There was a survey which was carried out of the banks, and there was an analysis which was done by the MCA. There was a mismatch between the charge that was created and the asset that really existed. And where did they find out? They did not find out when the company was submitted. They found out when they went for an NCLT, when they did an investigation, when they found that the asset never existed, or the company borrowed double the funds on the same asset. And that's where they came back and said, hey, listen, list down the assets which you believe belongs on which the charges are created. In fact, if you see the whole history of the first charge, second charge, even today in Schedule 3 is given. But by bringing in the details, it casts a responsibility on the company, saying, on the management, saying that these investments or these fixed assets exist, I own it. Typically, the way it used to happen, as a part of promoters' contribution to capital, they will bring their house, they will bring their assets, they will bring a farmlands, they bring everything, but they never register it in the name of the company. But they will say, this is my contribution towards my capital. So you set up a fixed asset, you set up a promoter's share contribution to share capital, and this is never transferred onto the company's name. Now, this is the real story as to why the information has been brought in, as to why the title deeds are needed. You are absolutely right. Large companies like what you've quoted, Tatas, is absolutely right, but not all are Tatas. There are companies which have been following practices which are other than what Tatas would do it. Do I then segregate between good and bad companies? I don't think so. That is possible. And therefore, this process of bringing the information is required, because the narrative of why is needed, if I explain, would probably help you to understand as to say, why was the changes required in the first place. Now, if you look at trade receivables, let me give you an example of this typical trade receivables. Auditor's responsibility on a trade receivables, send out confirmation. 90% of the times across India, you will never get a confirmation. Now, even if you get a confirmation, the confirmation would not even state, you will only put a stamp and send it across. Does it mean that this is tenable? See, if you get a confirmation, it's only established that there is no dispute as far as this is concerned, the receivables are concerned. But it does not establish whether the intention of the customer to pay you the money. And if you see, typically with amounts which are due with government agencies, semi-government agencies, large companies, and you see the age buckets. We had greater than 3 years, greater than 6 months, less than 6 months, and then we had this ECL model. Now the question is, if you categorize now disputes, undisputed, within undisputed and disputed, if there are any of the debts which are not, or where the credits are not impaired, you classify based on that, and then classify between good and doubtful. Just look at this. The balance sheet today, what you submit to any agency will not reflect how it is done. Now, somebody might say, sir, you have got stock audits, you have got concurrent audit, you have got this audit, banks does it, they have all this information. Do they have information whether these debts are recoverable or not? And when you ask, when the auditors ask the management, they say, no, sir, we have spoken to that person, sir, today only, they will give it to you by 3 months. Next year you go, if a private limited company, no, sir, I've spoken that actually, if you want, I can get you, they'll put you onto the director, sir, if you want, you can listen to talk to them and get it. And the question then is, if these are all delayed from year after year after year after year, you will say, sir, this is good and recoverable, but the monies are not coming. Now, when the monies are not coming, there is a working capital deficit. Now, when there's a working capital, so your receivables are not coming, you might say, I'm not paying my creditors, but I have to run my business. I'm not paying my inventory. I'm not paying my liabilities. But how do I run the business? No, no, sir. I will do one thing. I will borrow from banks. Now look at this. When there is a mismatch between a receivable, when you have a mismatch between the current ratios, then the real issue is your cash management. And that is the reason why you need to have the classification of trade receivables into this category: disputed, undisputed. Within disputed, I will take you through some of the details where you need to break in between disputed good, disputed where credits are impaired, disputed which is doubtful and to be provided for. If you break down, and I think it's very important, because if you're in an infrastructure company and dealing with the government agencies, and the government agencies, sir, these are all deposits, sir, these are all amounts which are called as recurring bills, we will get it, or the retention money amounts, we will get it at the end of the contract. These are all good and recoverable. Sir, we will classify these as current assets because we will get it. But the fundamental principle there is, if they are good and recoverable, why is the company not able to realize all that the contracts where it has got completed? Because you have those contracts which also has got warranty period. Why does there is a withholding amount? The withholding amount is not for the contract to go. The withholding amount is only for the performance. It's after the period of warranty that the money will come back. But when you classify as receivables, you'll say good, receivable, good, not no provision to be made. Sir, government, sir, we will get that money. When will you get the money? You will get it, which is outstanding from 2012, 2013, 2015, 16. But sir, government says the paisa aa jayega. I've spoken to this controller, he will get you the money. Now today you classify. Year 1 you classified. Year 2 you classified. Year 3 you classified. Someone when he looks at it, hey, listen, you have been classifying the same things like good, 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 good. How are you establishing these are good and recoverable? How are you establishing that these are not impaired credits? I think this is where the analysis will bring in. And the analysis also will bring in terms of the ratios. Because year after year after year, if you're remaining at the same level, without changing in your receivables, then, or without changing in your payables, then the issue really comes up. How are you managing cash? How are you managing business? Is it because of borrowed funds? Is it because of funds over funds? And that is where the whole issue came up from a bank. When I'm talking about 25% of our budgets are down the drain in the form of NPAs. And I think this probably, somebody might ask, are you saying it will change? The answer is no immediately, but down the five years down the line, this will have an impact. Take another instance, capital work in progress. And I'll come back to trade payables when I talk about loan. Capital work in progress. Take any company, the capital work in progress will be sitting for 5 years, 6 years, 7 years, 8 years. They say you keep on capitalizing the interest. You ask the auditor, sir, is there a section which will prove whether the accounting expenditure during construction period? What is your construction period? If you have envisaged a building to be completed within 3 years and it is not completed within 3 years, how is that you keep on adding that interest on that borrowed funds? Because they, sir, it is beyond COVID has come, sir, because COVID period, we cannot do it. Now, this aging of capital work in progress and intangibles is a beautiful thing. And both of them, whether it is a capital work in progress or an intangibles under development, you are doing nothing but taking the expenditure and adding to the capital asset. There is a physical asset called property, plant and equipment, but there is also an expenditure which goes and sits under your intangibles under development, because you said, I've developed a new product, sir. This product will be marketable, sir. We have got this basis, sir. We will make this money, sir. And especially this happens in pharmaceutical companies. And they believe that every R&D which they develop, they're going to convert into a commercial product. And therefore, there is always a fight within the auditors and the company saying, they, sir, this expenditure, this is the product, our R&D, sir, this is commercial viability, sir. Viability of this year itself is not saying, we are talking about viability of 5 years. I think that is where this issue of aging brought in. Now, what will happen to this? So you write aging of capital work in progress, greater than 1 year, greater than 2 years, greater than 3 years. Then you write original commencement date, original completion date. You have to give reasons year after year after year. Can you repeat the same reason? First year, because it is first year implementation, you're trying to understand concepts. But if this is not really capital work in progress, you as a company, you as the board of directors know that these assets will not be put into use, you should start charging it off. And I think that is where the directions comes up. Intangibles under development and capital work in progress. Talks about trade payables. And if you see, trade payables are another form of working capital loan, is another form of loan. That means you take every goods on credit, but you don't pay them within a period. That's also funding your own working capital. And I think that is why the aging is very, very important. Trade payables again classified between MSME and non-MSME. And I think that is fundamentally very, very important, because in the revised changes that has been brought in, I think you need to go back. If you see, there is a requirement under the Companies Act that every 6 months or every half yearly, the company should submit information relating to MSME. But if you see, majority of the companies which had this revision changes in the threshold of small, micro, small and medium enterprise did not send a revised list, because now the enhancement is from 1 crore to 50 crores to 250 crores. Now, if you've sent it across, probably today what you're showing under payables, trade payables, may fall under MSME. And MSME means if you have a credit period beyond the regulatory period, and if you don't make any payment within that period, and the interest you have to pay, and these gets disallowed. Now, this is a much larger issue. The issue is not just the classification. Issue is enhanced limit of MSME will bring in. If you are in the audience or in the participants in this forum, if you have a majority of them MSME, please go back and write to the companies in which are larger companies saying that we are MSMEs, because so far you are never classified as MSME. When you give a representations, you not only it will improve your cash flows, but will also make sure that you get paid for the unpaid amounts in the form of interest. And I think that's a very important aspect. One should take it, because this is a forum where it's represented by majority of the small, medium and larger enterprises. Title deeds. And I'll give you an example of a title deed. Lands. I gave an example where promoter comes in, he gets in his name, he never converts and never registers. And you see, in many of the balance sheet, which I myself have seen, it has not been transferred because we are waiting to get final clearance. It is not transferred because one of the family member is not agreed. It is not transferred because there is some change, you don't have the link up document. It is not transferred because there is a higher amount of stamp duty, whether we should go and do sort of a merger. Now look at all of these. Really speaking, if you say it triggers in your property, plant and equipment as a fixed assets in your balance sheet, you are saying it's my fixed assets. The company says it's my assets. But really speaking, I don't own that asset because it is not in my name. It is only figuring because there is a contribution. The other side is called promoter's capital. And this is where you need to start looking at all of this. That is, the immovable property is not held in the name of the company. It is a responsibility of the secretariat, it's a responsibility of the company, it's a responsibility of the auditors and the management to make sure that you go and trace back one time whether the property is in the name or not. Now, let me give you an example. The benami properties which keeps coming in. And if you really say that I don't want to come under wealth tax, I want to distribute wealth, and now typically it happens in when you some of the tax structuring happens when you don't want clubbing of income. So you do that structuring of it. At that point in time, you keep on distributing, but in the books, it shows as if it's the property of the assets. Now, if it is not held in the name of the company, you don't have to give all the details. It's not held in the name of the company. Wherever it is not held in the name of the company, you have to bring that details on whose name it is held. You're absolutely right. Can I go and keep on writing any number of it? Some companies like Tata's ITC may probably go and say, property plant held in the name of the company, ROC charge, date on which it is done, probably it might give. But what is important is properties not held in the name of the company. You have to give the title, name, property, and all of that. Next, the other way to increase the value of the assets was revaluation. The typical of, how do I improve my balance sheet? So you go and ask any consultant, say, सर आप काम कीजिए सर, आप रिवैल्यूएशन कर लीजिए सर, आपका बैलेंस शीट ऐसा बढ़ जाएगा, रिवैल्यूएशन रिजर्व सरप्लस आ जाएगा सर, you do this way. Now it says any change in revaluation of property, plant and equipment line wise, whether it is plant and machinery, whether it is whether it's your furniture and fixture, whether it's your equipment, whether it's anything else, has to be done by a registered valuer appointed under the Companies Act, and wherever it is greater than 10%, you have to provide the details. Now, this brings upon typically the issue where whenever a bank requires you to provide security, you just inflate or revalue a property and say, sir, aapko to kya malum hai, sir, ye land jahan Patancheru mein, now because of this so much of house property, the value of land has come. But if it is a factory land, are you going to use for constructing of a building for residential? Answer is no. I cannot benchmark some residential property coming in with my factory unless I believe that I'm going to stop this business. I'm only going to construct into a new called my infrastructure company. I think this is where the thought process have to come through and should change. Now, I even recently, very recently, in some of the records, land records, some of the names have hand. So therefore, the company gives a power of attorney. Now, if you really look at the Companies Act, all you need to do is have a power of attorney registered and registered with it, and the power of attorney can go back, keep on selling lands. In one of the recent incidents, when we did an analysis of in the land records, does this land belong to this company? We found that that land has been sold more than 3 times to some other person. Even today, the company still shows it as their own land and given that as a security. Just think through this. One piece of land which went through a power of attorney, the promoters have changed, but that power of attorney went and that guy went on executed. That's a registered deed on which any transaction is valid. Now the question is, you have to go back to the party who has finally purchased, go and plead with him and say, hey, listen, this is something there, but for him it's a valid transaction. And this is where the cases came up in terms of land. And land is one area which requires significant review, and that's where the immovable properties becomes important. Suppose you say promoters, if you say security given by the promoters is only given as security is registered, but this promoter went through a register of this thing and went and sold it off. Not all promoters do it, maybe few promoters do it. Then what happens to that transactions? And that is where the whole disputes have come through, and that's where when banks checked up with their, and when they did this investigation of forensic audit, they found out all of this. Shareholding of promoters. Now again, shareholding of promoters, why do you need to know this? Now, shareholding of promoters or promoters category or connected persons, these are some of the ones which are very, very important. You might say, hey, listen, this is applicable for those companies which are listed companies because they got liquidity. This is an illiquid, does not move, the assets does not change. The nature, size, and promoters holding remains the same. But what happens in the event of a death, in the event of a gift deed, in the event of anything else, in the event of a marriage, the shareholding keeps on changing. And that is the reason why you would need the shareholding of promoters, how it has changed. Is it through a registered gift deed? The moment a registered gift deed, the shareholding has changed. Now, what happens to the guarantees that are given, that are missing? Or your promoter holding, you went and took another loan, not in the consortium loan. These are some of the things which becomes very, very critical when it comes to shareholding. So that's the reason you need to provide all details. The biggest fraud that takes place across India, I mean, when I say biggest fraud, is the fraud which is done by the companies which is captured through an NCLT or a forensic is through related party transactions. I can identify 4 or 5 parties who are not related to me. I can sell this to somebody, somebody sells to somebody, somebody sells to, and again comes back to the same person. And this is a real story which has happened. If you see some of the investigation report, the asset has not moved, only the documentations have moved, only the transport document which you say the truck numbers have changed, but the truck dates have changed, the truck's numbers have changed, but everything remains the same. Now, this became a big issue. How do you identify related party transaction, key managerial persons, and all of this? Companies Act does not provide, the Companies Act provides a list. But what is important is, suppose you have a promoter, you are a promoter, and promoters have entered into a transaction with their sambandhi because it does not fall under their category of related parties, and then the monies are paid to that person. Is this a related party? You might say, sir, under Companies Act, under 187, all of this does not get covered, and therefore 177, 187 does not get covered, and therefore this does not fall under related party transaction. Very good. But really speaking, will you give the entire transaction to a person, a single person who never had a history? His balance sheet does not speak volumes of his financial credibility. He does not speak anything, but you've given to him. That is where you need to start looking at. And this giving of advances, typically some of this, while the banks have started coming up and looking more closely, saying that you give this money to your subsidiary, whether it's for end use. Now what happens is, and it's a real life incident which I'm sharing. I'm talking to you about from a real life incidents that really happens. Now, the company wants to immediately set up something in subsidiary. It cannot send money in the form of share capital because it does not meet the net worth. So the company says, I will enter into a transaction as an advance to the party in the subsidiary, and the subsidiary gets the money. What do you do with that money? That money is not, and you don't get this product for 3 years. Product is not received for 3 years. Now you find that the money is not received. RBI authorized dealers call you back and say why the money is not received. You might say this COVID, non-COVID, whatever the reason. Now you go back to authorized dealers and say, now I want to send back that money. I want to invest in that company so that I can get back that money. This really happens. When you do structuring, you do say structuring, say the law allows me and therefore I do it. But the fact is, if you've given an advance and an advance are not going to come back to you, then the very purpose of structuring, even though legally it's correct, even morally, even if you say I'm doing for the purpose of business is correct, but if it is not recovered, and majority of the companies in India is dying not because the parent company or the project holding company, which was incorporated originally to run the business, is failing. It's because when the flagship company was doing well, the flagship company diverts into different streams. Oh, somebody says, sir, today, if you see, we should get into pharmaceuticals, sir. All infrastructure company one day decide and will become pharmaceutical company because pharmaceutical company shares are going up. Pharmaceutical companies are not like this. So next day, the person says, sir, pharmaceutical, this product API is not working, sir. Let me get into big data management, sir. Let me get into analytical, robotic, RPA process, those things. I then tie up with somebody. Now the question then is, do you have the right person and the right place to do the right business? The answer would be resultant would be seen. That means, does the subsidiaries or joint venture or associates or any companies that you invest or partnership or LLP or anything you invest, does it return you the return on investments if you were to invest similarly in some such companies which are not related? If the answer is yes, then this is a very easy answer. You will have a very good banking facilities. You are a profitable company. You are a very good dividend paying company. You have no problem. But if your good money goes after bad money, in fact, one of the companies when I said, you have this flagship which has X number of amount. You have the subsidiaries which have got X minus amount. You borrow this money and give to X minus amount. Anyway, not going to come. Your return on your sales or your EBITDA are not so much that it can support your main low financing, your additional financing. And therefore, even this smaller companies will drag the flagship company. And that is the reason why loans or advances to promoters, KMPs, related parties in the nature of loans, either repayable on demand or having no terms of or period of payment amount and proposal should be brought in. I think this is a very important aspect. If every company believes that they are very good companies, they believe that the subsidiaries are excellent, let the subsidiaries borrow loan, parent give a corporate guarantee. Why should a parent company borrow and give that money as advance and that advance never comes back? So you take any balance sheet, you have assets, you've got inventories, property management inventories, the significant part of it falls under investments. And I think that is what is very, very important. Again, I'm saying it may not be applicable to all the companies, but larger analysis when you make analysis of such type of companies which were involved and why we are talking about 25% of our GDP gone into non-performing asset, this is one of the reasons why it has gone through that. The other aspect of it is only a minor modification relating to current maturities to be disclosed as short-term borrowings. Nothing but, all your current maturity, that means any amounts that are prepayable within a period of 12 months, you are classifying under current liabilities separately without showing as a borrowing. Actually, this should fall under the borrowing. These are corrections which was done to reflect the nature of that amount. Security deposits, again, is only a reclassification. Lease liabilities, again, on a classification. Then the other point, which is very important, is undisclosed income. Now, let's take care of undisclosed income or transactions. There is a survey which happens. We have all these tax specialists. They go through, they say, sir, like this is the problem. But somebody might say, sir, they may have to meet a target. That's as in they came back. Let's buy peace. Let's buy peace. And we'll say, we'll go and take this as additional income not disclosed. Two aspects that come to it. Auditors now reporting saying this undisclosed income of transaction not recorded in the books of accounts and but surrendered in tax assessment. If it's an issue of a judgment, right, or issue of a classification, then it is not an issue of account. It's not an issue for an auditor. But you say, sir, I forgot to record this transaction, sir. Actually, this was a sale made. We forgot. We missed out one cash receipt book, sir, which is actually sold some branch, I think, because we sold, and therefore this is income. We want to buy piece, because if you don't buy piece, my actual income is much, much higher. Now you've recorded, and now what happens to that income? This income relates to a transaction not to the current period, but the period in which an audit was issued, giving a true and fair view based on the examination of books and records. Upon such examination, we give a true and fair view that the financial statements that are drawn up give a true and fair view. Now you have an undisclosed income for transaction. So you might say an argument saying, no, sir, we have to buy piece with the income tax department. Where will the auditor buy piece? Will you say now undisclosed income means this books was not fairly stated? How much such type of incomes are there? Now, there is a funny aspect of it which you need to look at it. This internal control over financial reporting was introduced. This is a mockery across, why we need to have that. Let me be very honest with you. If internal control over financial reporting was operating effectively in the manner in which it should operate, why should you have undisclosed income? Because you say every transaction that has to be recorded should be initiated, should be processed, should be reviewed, should be approved, should be recorded, should be paid, should be closed. That is internal control. Now, when you say you have a control which has been established, and now you say this undisclosed income is not recorded, same will apply to your trade receivables, same will apply to your fixed assets, same will apply to all of this. So this internal control or financial reporting, whoever gives it, I don't exclude myself also. Unless we understand the impact, you should start qualifying internal controls also. The day you can qualify internal controls, your financial statement, when you look at it, and I'll tell you why this becomes very, very critical. One of the auditor's report that got introduced was an issue of going concern. That means this financial statements have to be prepared on a going concern basis. We all know that we have learned from this thing. Every financial statement that is drawn up other than on liquidation is prepared on going concern basis other than what is noted. What is other than noted? So the parent company, holding companies gives a letter of comfort, or they have made alternative arrangements. Now, one of the points that have been brought in is an element of ratios. I'll touch upon this early because this is also very important for everyone to understand. You have to compute ratios like your gross profit ratio, turnover ratio, debt equity ratio, adequacy ratio, interest service charge ratios. All ratios you have to compute. And if there are variations between current year and previous year, more than 25%, you have to explain. Now, when you explain, and what happens, typically majority of the current ratios, you find your debt higher than this thing. Now, one of the requirements under the Schedule 3 is the board of directors under section 134 have to confirm whether the company is in a position to meet all its financial liabilities. That means in your going concern, you say the company financial statement prepared on going concern, but when you see the ratios, it's all negative. Your debt ratio is higher on debt. Your interest servicing ratio is very, very low because your profitabilities are low. Your current ratio is very, very low. So when your current ratios are low, how are you going to make the payment? Is this financial statement going to be on going concern? There is an interlink between the ratios that you will give under part of the new balance sheet and what you give as a going concern on the financial statement, saying the financial statements have been prepared on a going concern. Other than that, and the auditor's opinion saying that these financial statements has been prepared on a going concern basis. There is so much of interlinkages that brings in. Next element is on corporate social responsibility. The corporate social responsibility went on to different reviews. Now, I'll tell you, this is where, why does a government go after people to bring in more details? When corporate social responsibility was introduced as a percentage of net profit, the original intention was whatever you receive, you share about 2% of it, average profits, so that the society gets benefited because they indirectly do not get any dividends of your profits, your betterment of the society, betterment of people, betterment of facilities, road facilities, and all of this. Now the corporate came up with, you appoint consultants comes with innovative ideas, sir, we will do it under section 32, we will do under section this one, we will do under section 36, we'll claim under this, we'll claim under that, you transfer to trustee, we'll go under section 80G. Now the question is, the intent was not for you to transfer to an 80G, not to get your benefit and all. The intent was you to spend. So it started with provisioning only as a disclosure. Then it came up saying that give how much of the amount not spent. Then came up saying that what should you do? Now what has come? If you say this is the amount that is identified towards contribute details for social responsibility, you need to park it into a separate bank account within 30 days from the end of the period, or 6 months if it is identified to a project. Somebody might say, sir, I've contributed to COVID, so this is a part of my CSR activity. But the CSR activities, which is not includes all of these, may not cover necessarily related to this. And therefore, you need to see what is, sir, I have paid for my employee insurance, sir. I paid for my employees' COVID hospitalization, sir. Can I take this as my corporate social responsibility? And these are the typical questions which keeps coming up from the corporate, because the corporate believes that, there is COVID is something which is not our own created, it is created by the nature, and nature is created, so therefore we are not responsible, therefore we have not budgeted, therefore it is the government should give us the benefit. Sir, if the employees work for the company earns for the purpose of profit, and the company pays them salary, it's the responsibility of the companies to make sure that employees are taken. Why do you need this towards corporate social responsibility? Corporate social responsibility is to the society other than what they belong to, and that's where it brought. The other aspect which has been brought in, and again, I'm telling you why these are fixed. In fact, another thing which in corporate social responsibility is fixed is that in relation to any contribution to any fund, I have a fund, I'm, let's say, X company, I have my sister concern. So I've created a foundation called Sister Foundation. I transfer all this money to foundation because my trustees are all somebody else whom I know, and they will take care of it because they can draw salary, they can do all of this. Now the question comes up is, other than normal administrative, these expenditures should be spent for the purpose for which it has been given. And therefore, you need to be very, very clear that when I'm contributing 2%, that's contribution to you, this is for towards what? Towards for betterment of water drinking, towards for sanitation, towards for some road development. What is it for? You have to define that. Or towards my administration. What extent? I cannot take 50% administration, 50% goes this. this cannot be a basis of taking back the money. And I think this becomes a very, very critical aspect of it. The another change which has been brought in, which will have an impact, it may not impact the accounting standard rules, because this is where it goes an exclusion, because fair valuation through profit and loss doesn't work. So therefore it is applicable to other than accounting standard rules. These are applicable for those companies which fall under the Ind AS. What does it say? Any errors of prior period errors cannot be, in today's world, you do and say prior period, sir, we forgot to record inventory, we forgot to account for depreciation, we forgot to do, you do prior period. Tomorrow, when you do for 31st March 2022 balance sheet, any prior periods will now be constituted as restatement. Prior period again defined under the accounting standard rules, Ind AS 8 or under the AS 5. Wherever there is a prior period relating to such, you need to identify and account for it. Now it comes as restated financial statement. That means you go and restate relating to the earlier period. And that is what the change would come. Next is separate column to be given for defined benefit plans. But another important aspect of it, which is very, very important, is wherever a defined benefit plan, right? Wherever a defined benefit plan, because of your own rating, for instance, you said my borrowing rate is 10% and my return on investment is 12%. When I'm calculating liability, my own equity value has come down. That means my 10% has become 12%. That is, your own equity is going down, your rating has gone down. Any rating, any changes in the financial liabilities, which comes under actual gains and losses, which sits under your statement of other comprehensive income, now because of your own changes relating to your rating or fall in the value of credit rating, will now go to P&L account, will not go to other comprehensive. That means because of your debt rate going up from 10% to 12%, that means your businesses are doing bad. And that's the reason why it has gone up to that level. And this is something, it's your own equity. If it gets deteriorated, you need to identify that and show it. Next aspects, details of quarterly returns and summary of reconciliations of borrowings against security of asset. And why this is very, very important. As I said, we will have to go back. We have to go back now to the concept of, how does a bank fund the working capital? The bank receives information from the companies in the form of stock statements, in the form of debtors, in terms of payables, in terms of working capital, based on which a drawing limit is identified. Could be 75%, could be 60%, could be 90%, depending upon the strength of the company, basis on which the funds are allowed. Now the issue here is, if you're a private limited, if it's a listed company, there is a quarter closing. But if you're a private limited company, which is audited by an auditor, you don't have closing every quarterly. You're closing only every annually. That too happens closer to the filing of return or closing to the, when you have to hold AGM, the last day of the AGM, you hold it. Then the question comes up is, how do you identify it? Does the company close its books of accounts on a quarterly basis? This is where you need to bring this information saying that every company now has to close its books of accounts on a quarterly basis, if not on a monthly basis. Only then the auditor will go take this information. How do you identify this? Again, you identify, and this is again a 5 crores loans, borrowings from a bank. Okay. Working capital, term loans, sanction. You see, suppose you have sanctioned 5 crores. You've drawn only 2 crores. Will this be applicable? The answer is yes. 2 crores plus 3 crores undrawn will be applicable. All term loans, every loan will be added. And if it is more than 5 crores, you need to have this done. And this is a very important aspect. Next, details of utilization of borrowed funds and share premium diversion of funds. And this is the most difficult aspect of it. Earlier, the end use of funds was only for relation to term loan. I bought a plant and machinery, went and purchased a plant and machinery The company sanctioned a separate loan for that. I've utilized it. The plant has come and now done. Now, this is a broader definition. Details of utilization of borrowed funds and share premium. So you're going to go into entire details. That means if I've got a working capital, let's say if I've got a working capital for my stocks, receivable inventory, payables and receivables and payables. Now I've taken this money I've utilized for buying a capital asset. Under those circumstances, you need to look at it and look at entire cash book, entire bank book, and make sure this is identified. And identification is a very critical aspect of it, which you need to complete. And this aspect of it, especially relating to utilization of borrowed funds, is now extended to the entire borrowed funds. To whom? Intermediaries receiving from a fund. That means whatever money you have given, suppose the subsidiaries, I want this money for the purpose for which it is given. Let's say, for instance, it is being given for, let's say, purchase or investing in a land. Let's, for instance, that you've given a money to your subsidiary for investing in land so that you're expecting some more additional capacity. The subsidiary, instead of spending money on the land, went on and paying its salaries and all of that, did not buy the land. Do you have to give the utilization of borrowed funds? The answer is yes. All these advances for which it's been taken, been given, you need to provide that information. Details of Benami property sale. And this is a very common thing. Now, again, many of the companies, there is a saying that a promoter, there is sick companies, there are no sick promoters, because promoters never hold any investments, never hold anything relating to themselves in their own name. They may distribute to various people. And it has happened actually, if you see, some of the drivers are holding the property, some of the servants, some of the cooks, this has happened, and that's the reason why all of these has come through it. Now, the question of Benami properties, right? And if you have any idea, again, this is again identified during the period, you need to look at it and then only you have to report it. That is the reason why it is very important is you need to keep on looking for this information, both as a company secretary, both as well as an auditor, identify if there are any properties which falls under the category of Benami property. Again, Benami property is various, it's a vast subject, which is from an income tax perspective, it makes much more understanding, and you need to understand much more deeply under the Benami Properties Act itself. Next, the most other aspect of it, and this is something which is going to be a challenging thing. Details of default, if the company is declared as willful defaulter, a bank or a financial institution. We as an auditor, we as a company, we may not even know, we don't even know whether the banks have identified this company as a willful defaulter. Now, when you send out confirmation, and this is again, I went back to the ICI also, the authority, I said, hey, listen, you are saying that you send confirmation, the bank does not confirm, saying that whether they're willful default or not. I said, now you include this column, specific point saying that whether in the opinion of the bank, this company is identified as a willful defaulter or not, or bank, or suppose you have a consortium bank. 5 consortium banks have not identified you as willful defaulter. There is one outside who's really rejected because you have not given him that business. So you've identified you as a willful defaulter for some small reasons. This becomes an important aspect of it. You have to identify and report it. The other aspect relates to delays in registration of charges or satisfaction during the statutory period. There are many charges which are not credited. Typically 30 days, then went to 60 days. This is something which, because of this fixed assets and classification, will come through it. Specific purposes. Again, specific purposes means those identified for which you're purchasing it. And I think this is a very critical aspect of it. One should look at it. Next, details of somebody asked me, what is this virtual currency, cryptocurrency? This is cryptocurrency. So far in India, it is still not evolved, but there are a lot of guidances required relating to cryptocurrency and for which, and the virtual currency. If you have got transaction outside of India, you need to come back and provide all of these. Disclosures of ratios along with explanations of computation details. Anything about 25%, you need to provide all of these informations. disclosure of compliance under Section 287 of approved scheme of arrangements and deviations. Sorry, this is relating to where there is scheme of arrangement Section 237, you may need to bring on all of these. Compliance with the number of layers of companies, that means you cannot have investment companies more than 2 under Section 287, you need to bring out. And if you have any relationship with struck-off companies, and this is where you need to get more details. If it is relationship with struck-off companies, that means you're dealing with companies, the company never existed. Let me give you an example. And how fraud happens, and especially it happened in a live case. How does it happen? In a fraud case, these relationships, the company, so it was in a car manufacturer, car dealer, they were car dealers. They were selling this to a party. The party never existed. When the party never existed, the bank did what is called an investigation, found that this party never existed, and therefore about 20 crores or 30 crores just went off. The car sold with actually without a company not being there. When they look at the company under the Companies Act, they found that this company never existed. The company never existed, or the company was a dormant company. In India, more than 2 lakh companies have been struck off. And we need to, as auditors, as companies, we need to look at it. If there are any relationship or transactions with such companies, if you have transactions and relationship with such companies, you shall provide all this information. And I think this is a very important aspect of it. It's, lifting of corporate veil. And let me tell you one thing. Proprietary of a transaction is not what is done by an auditor. Proprietary of a transaction is only done in a company by the promoters and related to them. So therefore, what this whole changes brings in, the changes that has been brought in brings about that the impact that it can bring in on the company, the impact that can bring in on the auditors. Now the auditors no longer can say, sir, I will commit on 15 din ke pehle aa jayenge, sir, hum aap audit kar denge, sir, aapka de dega because from a tax perspective. No. If you are an auditor under the Companies Act, you need to provide all of on a regular basis. And I think this is a very important aspect of it. I'll just pause here if there are any questions to take while I fix my charger. If there are any questions at this point in time, unmute, and if there are any questions till such time. Hello.
Yeah.
Vikram, you're able to hear me, right?
I can hear you. Yeah. You scared us enough that people are stunned. No, really, some of these amendments have to set us thinking, and it depends on what I said earlier. It is a lot of work, lot of organization of data, and some things like and a lot of opinion converted to fact. Something like ratios, for instance. The way I compute a ratio will be different to the way you think of a ratio. So tomorrow someone can question, how did you arrive at this ratio, whereas actually it should be this for the same title of current ratio. What goes into current asset, my opinion could be different from your opinion.
Correct.
So I can see some minefields in this. And hopefully over a period of time, we will be able to solve it. I can see that they're trying to overachieve what they're trying to do, I mean, frankly.
Just a minute, I'm just setting up my chart. I'll just stop my video and just take it out.
Yeah. No, I think that they're trying to overachieve. What I can see, the details of default, if company is declared a willful default, they want the details of default. Now, default doesn't occur in one shot. default occurs over a period of time. So I have to form an opinion as to why the company and the auditor, they have to form an opinion as to why it is declared a default. And the details of default have to be given. What do we mean by details? Does a detail mean that the amount which is due to be paid is not paid? Is that enough detail? Or we should say, these are the reasons why it has not been paid. We form an opinion why it is willful or not willful. I mean, these are onerous responsibilities on the management and the auditor. Which management will admit that it is a willful default? Very, very difficult. Very rarely, if ever. So if they do not admit, how will the auditor take an opinion? And if the notice for willful default comes, not yet declared, then what happens in the interim period? Because we all know that it takes time from the point of notice to the point of declaration. It is sometimes, I am aware of cases where it's 2-3 years. So during these 2-3 years, what will the auditor say? Does he give details? Because of luckily we can go by the legal word that is declared by. So once it is declared, what kind of details will be given? These are very, very complicated questions. And sometimes I feel that they're trying to overachieve. The banker has formed an opinion that it is a willful defaulter. So who are we trying to tell? We are trying to tell the shareholders that this is the reason why there has been a willful default. We are trying to tell the creditors and other institutions. Of what value is that? These are, again, once again, very, very difficult questions to answer. But I think that as a Chamber of Commerce, I would only appeal that, you cannot expect that these things will be reversed. So you should only be trained to cope with the problem and understand that a lot of responsibility has been placed both on the corporates and on the auditors on this. We will all work together, but it is burdensome. That's all I would say. But in the interest of the country, in the interest of corporate discipline, I think that we will be going ahead with this. That's all I would say. Over to you, Tasneem.
Thank you, sir.
Sorry, you're able to see me now?
Yeah.
Sorry, I don't know. There's something suddenly it conked off. Right? Okay, sorry. Can I have the questions if there are some questions which are there, and then before I can.
Yeah, you want me to read?
No, let me just see because it's easier for me to do this one. So there is one in heavy industry. Is it really possible for auditors to know the genuineness of statement given by companies on fixed assets? So
Ganesh, before you answer, remember you are an auditor.
No, I'm talking as an auditor only. I'm talking as an auditor. So all this while we have lived in the world called Aludu, right? The Aludu regime is no longer available now because the government believes auditors have not done enough. And if the auditors have not done enough, is it really possible for auditors to do it? The answer is yes. Otherwise, states saying that we are not able to verify the genuineness of the fixed assets, and therefore we are not commenting on the security of the fixed assets given as loans to the bank. Therefore, we are not commenting on the charge created, and therefore, in our opinion and explanations provided, the financial fixed assets stated are not correctly stated. I think it is too large a statement. So I think what is important for all of us is to say, is it possible? The answer is yes. Because when you are validating fixed assets, because you also validate under income tax classification greater than 180 days and less than 180 days, you've got all your income tax statements, you've got all the fixed assets that have been taken. Physical verification under section 134(5)(e), it's the responsibility of the board of directors. They have to plan out the responsibility. When you say responsibility, because their responsibility is safeguarding, their safeguarding goes through the management, which is they have to carry out a physical verification under the internal control process of closing financial reporting closing process. This is one of the aspects where does the asset exist, and that has to be carried out and has to be done. You may probably do a one-time exercise. In fact, many of the companies have done a one-time exercise to make sure. This also gives you an opportunity to re-establish the fixed assets, which was not done for all this while, and to make sure it exists. If you see, if there are larger companies which are aged companies, Most of these fixed assets would have been written off. It is only, see, typically if you take a 30-year-old company, it would have been written off all of these. We are talking about, let's say, 15 years, 10 years. I think it's easier to find out. Where it is not possible, not material, just ignore it. But this is a very important aspect. The amendments are effective 1st of April 2021, and therefore we are already in the period of applicability. How to measure the life of intangibles created in software IT industry? You have to classify. See, this is the beauty of in an IT industry. IT industries create something saying that there's a license. License could be for a period. License could be perpetual. So there are two things you should need to look at it. When you say license, license is what you should be able to generate revenue or profitability. So when you measure the life of an intangible, typically any intangible, if it does not have marketability, if it does not have any of the products, which are generally available off the shelf, it is generally written off. Unless you are in a position where there's a specific proprietary product or which you have actually developed, and that you can sell it off over a period of time. So it can range from 5 years, 3 years, depending upon when you are getting the next, whether the software gets the useful life of the software goes down, because the technical obsolescence in an IT industry is far higher. So you cannot have anything. Suppose somebody says I've got for 10 years, it becomes difficult. Typically, you can look at between 3 to 5 years as a range that some can measure it. Some people measure it as a life using the income tax of whatever they get as 1/6 of that or 16%. What disclosure should be done for an undisclosed income, unsurrendered tax assessment? You need to give the nature, name, reason why this is undisclosed. Is it oversight, overkill, all of this? I think that becomes a very big issue. You're absolutely right. It's an onus on, it is not so much easy to go back and say, hey, listen, we forgot to disclose this income. We forgot to put this expense. We have actually claimed excess expenditure, all of this. I think we need to understand, go through what has been concluded in the tax assessment, identify that if these amounts are material, you may have to go and restate it. You have to restate the period in which it relates to it. And if it is under Ind AS, if it is not under Ind AS, under accounting standard rules, give the name, amount, particulars, the reasons why these are classified under undisclosed income. If required, modify your opinion under your auditor's report, modify your opinion under your internal control over financial reporting. I think these are the questions that came up during the discussions. There is another question and answer in the question box. It appears that these amendments require auditors to put in more effort in eliciting information from companies. But if the companies are not forthcoming, how should auditors respond? What is important is build the trust with the companies. I think what is very important for all of us is go and educate your client, go and explain to them these are the changes. Because the reason is the changes are coming right from the company side first, then only the auditors are coming. The auditors are not coming first and then the companies are doing it. So if you engage with the company, help the company to put in systems, because a lot of modifications have been brought in the systems and a lot of things thinking has to go through. It is not that easy. The way the presentation PowerPoints is there, it is not that easy that every company can go. Just take, for example, how do you identify related party transactions? Now, with so much of changes coming through, you need to identify those transactions with that company which seems to be not similar or peculiar. That means that transaction with that company indicates favoritism in price, favoritism in terms of pushing the product, favoritism in terms of price sensitivity, favoritism in terms of credit period. If you have any such indicators with those companies, by nature, through the definition of connected persons, it will fall under the category of a related party transaction. And I think that is where the second most difficult aspect of it. Many companies do not have bank accounts maintained separately. To have a bank statement itself is difficult, bank accounts. How do you identify diversions of funds? You need to go back to every cash transactions, identify the major amounts which are material or significant, and relate for what it has been utilized. See, there is some people may say, sir, we've used both capital and working capital in one account, we maintain it, we don't make a distinction. But what is important with this change is brought in, you need to now go and tell the company, listen, you need to segregate. You have an opening balance, segregate between what is from operations, segregate what is from capital, segregate what is from investing or like that. Once you have identified categories, then bucket it twice. Otherwise, what happens is, one other way to look at it, if you draw a cash flow statement, if your cash generated from the operating activities, if the cash generated from the operating activities are lesser than the cash generated from the financing activities or investment activities, it means funds seems to be diverted elsewhere. This is the test. It is an indirect test. A direct test is, I take a bank statement or a bank cash book or a bank book, identify what is used for current account, what is used, term accounts, what is it used, and then do it. So you need to work with your clients, with your companies, and make sure you identify it. Is there a work which is gone up for all? The answer is yes. Is there an awareness that should be created with all? The answer is yes. Now the question then comes up, if you, for instance, you might say, sir, I will only prepare for current year, I cannot prepare for the previous year. How do you compute ratios? Will you then say, I will compute ratios, these are not comparable ratios? Because any ratio more than 25% you need to reflect upon. Now, this is where you need to go back to the company, sir, not only for the current period, but from the previous period. See to what extent you can apply to it. This is MCA, mandated now. It will not change unless the Federation Chamber of Commerce or CCIs or CIIs or anybody, NASOCHAM, anybody goes back to say ASHOCHAM, NASCOM, anybody goes and say, hey, listen, sir, we want to, they might only defer it, but this will be implemented. It's not going to go away. The best way is prepare, because your enhanced, there is the MSME has got enhanced. Now, what really happens is the way you do business, this is where I'm trying to tell you, next 5 years, the existence of audit will go away. Audit is not going to be there, because I'm going to talk on future of audit in Dubai. I'm doing it on this Saturday, the future of audit. The auditor and the auditees just gone, disappear. It's a transaction to transaction deal. Today, if you see, a great example is Amazon. Great example is Uber. Great example is Swiggy. Where is the client contact? It's through a delivery mechanism, and accounting is done through a pay. So now the question is, there is no, the gateway is completely different. The person who is actually providing a service is different. The person who's actually selling it is different. The person who's housing is different. The experience is gone. The transaction accounting happens, and billions of dollars happens through the e-commerce. So when e-commerce is happening, when transactions are happening, you are buying your own stuff. You can buy a mobile. You can buy an experience of a television. You can buy anything without even going and getting into the market, and can make that. Today, why? You're urban club. So when you have urban club coming through, you don't need somebody to come and clean. The guy comes and cleans. So everything is at your home. So the question then accounting becomes is what is called as to technology to come. So they will use bots to make sure, use artificial intelligence. Bankers will establish any transaction that triggers off with a check number, because check has to be given. It automatically uploads into the system. The bankers will be able to analyze for what purpose it has been taken. So the day is not far away that your mainstream accounting, your banking system would be connected to the server of the bank, and the bank does not require you to submit any statement. They themselves will be able to do it. That is the extent of what changes can come to it. Next, it appears these amendments require, this is done, which is the other one. Is there any other questions? Or in a chat box, there is some question come up. Can we understand as related party if RM we sell to company and taking FG along with money where I'm collecting R? If raw material we sell to X company and taking finished goods back with money, we're paying through FG and collecting on. No, suppose if you have got contract manufacturing, if you go through subcontracting or contract manufacturing, that comes under a job work, and therefore it is different. What I'm trying to say is, where you have got transactions which are not covered under the definition of a related party transaction, but substantial part of the money transactions happens with the company, which is favoritism to such companies, though they do not fall under the category of related party transactions, could have been price beneficial, credit period beneficial, terms of condition beneficial, payment beneficial, all of that beneficial, then discount beneficial, or vice versa. Under those transactions, you need to identify them as a related party transaction. And this is where it is lifting the corporate veil and going beyond the corporate veil. And that becomes very, very essential. Anything else?
So you had covered all the queries in the chat box and question and answers. I think with the President's permission, we can end it here. I request V.S. Raju sir to go ahead and give away vote of thanks. Any other questions? I mean, thank you. No more questions, but people, it's a lovely session and they are asking for your PPT, sir. Everyone is praising.
I've got only 2 slides.
But it captures a lot of data, sir.
I'll share it with you. I'll share it that with you. I'll share
Yes,
that.
sure.
As Vikram, and so Vikram, you have got any points? Because I want before just Vikram to.
No, I think you have captured the mood very well. Nothing can be more informative than that. We'll have to see how it evolves in this world.
Over to you, Raju sir.
Yeah, I'm very thankful to you, Mr. Vikram, and also Ganesh. We have analyzed the Schedule 3 compared to Schedule 6. As you are quite aware, the Companies Act of 2013 has given more detailed way and also given more disclosures, especially for the corporate sector. And Mr. Vikram is very thankful to you for whether he is overburdened and also is going to be disclosures, also over-regulation, etc. The corporate sector is still feeling because of the more regulations, more disclosures, etc. It is a overburden actually. 213 Act itself is most probably because overnight they are issuing the circulars and etc. That's why it's becoming overburden for the corporate sector to comply with the overnight all these things. We are also very thankful to Mr. Ganesh, who has very minutely, deeply analyzed the Schedule 3 of the Companies Act of 2013, because he has gone to the current assets, current liabilities, and also non-current assets, and also deeply he has analyzed it, and also these amendments of which will come into force of for the year 21-22, I think 21-22. Now that naturally the previous years also, because you have to disclose the previous year's figures also in the 21-22 balance sheet, that 2021 also has to be gone through it. We are very thankful to you for sparing your time and minutely analyzing the Schedule 3 of the Companies Act of 2013. I'm very, very thankful to you. Thank you.
Thank you, sir. Thank you very much, sir.
Thank you, one and all, sir.
Thank you, sir.
Yeah.
Thank you, one and all.
Thank you.
Thank you, viewers. Thank you, FTCCI team.
Thank you. Thank you.